NVIDIA $40 billion in AI revenue just hit a saturation bomb, and your tech paycheck depends on what's next. Here's what you need to know in the next 8 minutes. NVIDIA growth guidance just collapsed from 126% year-over-year to 24%. That's an 81% slowdown. On their Q3 2024 earnings call, executives used specific phrases that signal AI chip demand is plateauing, not accelerating. For tech workers holding NVIDIA stock, vesting RSU grants, or working at companies dependent on AI infrastructure hiring, this matters immediately. Part 1. The numbers nobody's talking about. Let's start with what happened. In Q2 2024, NVIDIA guided for 126% year-over-year revenue growth. By Q3, that dropped to 24%. That's not a miss, that's a cliff. A single quarter destroyed 81 percentage points of growth momentum. To put this in perspective, this is the steepest deceleration in NVIDIA growth trajectory since they entered the AI chip business in 2016. The company went from being a 10x growth story to a 5x growth story in 4 months. But here's where it gets interesting. NVIDIA absolute revenue in Q3 2024 was around $18 billion, and they're still printing money. The problem isn't that they're shrinking, it's that the rate of growth is falling off a cliff. For investors, that's the difference between a momentum stock and a mature stock. For employees holding RSUs, that's the difference between a 40% annual grant value and a stock that's flatlining. Let me give you concrete examples. If you're a senior engineer at NVIDIA with a 4-year RSU grant of $500,000 awarded in mid-2023, you were expecting to vest into significant gains. At NVIDIA peak in 2024, your vesting profile looked like this. Year 1, $125,000 at maybe $135/share. Year 2, $125,000, potentially at $150/share based on momentum. Year 3-4, $250,000 betting on $160+/share. That's $600,000 plus total package. But with guidance at 24% growth and deceleration signals flashing, institutional investors are repricing NVIDIA. JP Morgan and Goldman Sachs both issued reports in October 2024 suggesting NVIDIA could face 12-18 months of normalization. If NVIDIA stock stays flat or declines 15-20%, your year 3-4 vesting becomes less valuable in absolute terms. This matters because NVIDIA employees skew heavily toward RSU-heavy compensation. The company doesn't pay particularly high salaries relative to peers like Google or Apple, but the stock grants made up the difference. That equation just changed. Part 2. What the earnings call language actually meant. This is where the signal gets really important. On the Q3 2024 earnings call, NVIDIA CFO Colette Kress used 3 phrases repeatedly. 1. Inventory normalization. 2. Demand moderation in certain segments. 3. Customer purchasing patterns shifting. Let's decode each one. Inventory normalization means customers overbought. Here's a real example. Meta spent $15 billion on AI infrastructure in 2023-2024. They bought NVIDIA chips aggressively, but internal reports leaked in Q3 2024 showed Meta's AI compute utilization at 40-50%. They had more chips than they could productively use, so they slowed orders. That's inventory normalization. Microsoft had the same dynamic. They invested $13 billion in OpenAI and spent roughly $80 billion on data centers through 2024. But Copilot adoption has been slower than expected. Azure's AI revenue is growing, but slower than the infrastructure spending would suggest. Result: Microsoft signaled to NVIDIA in Q3 that they'd be moderating their next-gen chip orders for 2025. Google did something similar. They deployed TPUs, their own custom chips, more aggressively and signaled publicly they'd be diversifying away from dependency on NVIDIA. That's not a small signal. Google's spending has historically been one of NVIDIA's 3 biggest customers alongside Meta and Microsoft. Demand moderation in certain segments is the real red flag. NVIDIA tried to be specific without being specific. They said demand in Chinese markets was moderating, likely due to geopolitical restrictions and local competition from Huawei. But they also hinted at moderation in training compute versus inference compute. Here's why that matters. Training, the expensive part, building new AI models, has huge margins and massive demand from OpenAI, Anthropic, and other labs. But that's maybe 20% of the market. Inference, running existing models, is 80% of revenue, but has lower margins because it's more commoditized. If demand is shifting from training to inference, NVIDIA blended gross margin gets crushed. The company's gross margin had expanded to 75% in Q3 2024. Analysts are modeling contraction to 68-70% by Q1 2025 if this trend continues. Customer purchasing pattern shifting is the third code phrase. What does that mean? It means customers are looking at alternatives. Custom chips, Google TPUs, Amazon Trainium/Inferentia chips, Microsoft's Maya chips, competitor products. AMD's MI series GPUs, cheaper, 70% the performance, 40% the cost, inference optimization. Companies like Mistral, Llama 2, and open source models mean you don't need as much NVIDIA compute once a model is trained in Q2 2024. AMD announced their MI300X GPU would compete directly with NVIDIA H100. It's not as fast. Benchmarks show it's 15-20% slower. but it costs $40,000 per unit versus NVIDIA $50,000-$55,000 per unit. For price-sensitive customers, that matters. AMD took 0.3% of the data center GPU market in Q2 2024. By Q4, analysts were modeling 2-3% share. That doesn't sound like much until you realize the total addressable market is $150-200 billion annually. Part 3. What this means for tech workers specifically. Now let's connect this to your paycheck. Scenario A. You work at NVIDIA. If you're at NVIDIA, you're experiencing this in real time. The company typically awards annual bonuses based on revenue growth targets. In 2024, most employees had bonus targets that assumed 80-100% YoY growth. Guidance at 24% means bonuses could contract 30-40% in 2025 depending on actual result. Bonus example: a senior engineer with a $180,000 salary might have expected a $50,000 bonus, 27% of salary in 2025. With growth missed, that could drop to $30,000-$35,000. That's real money. Moreover, NVIDIA hiring will shift. The company hired aggressively in 2023-2024, bringing on sales engineers, customer success managers, and software engineers. Those early career hires with lower RSU grants are at risk first. Attrition is already up 15% according to Blind Internal Employee Discussion Board in Q4 2024. But here's the silver lining. NVIDIA is still growing at 24% YoY. That's exceptional by any normal standard. The company's balance sheet is fortress-like, $60+ billion cash. They're not cutting, they're just moderating. Scenario B. You work at hyperscaler, Meta, Google, Microsoft, Amazon. If you're in infrastructure, data center, or cloud engineering at one of these companies, the implications are mixed. Short-term, next 6-12 months. These companies will be more cautious with headcount. Meta specifically has said they're slowing hiring in 2025. Google said the same. Microsoft is more ambiguous but also signaling caution. That means fewer infrastructure hiring pushes, engineering, TPM, program management roles. More scrutiny on AI infrastructure spend, meaning your team needs to show ROI. Slower promotions tied to headcount planning. Midterm 12-24 months. There's a second-order effect. If AI infrastructure growth slows, the companies that make money selling AI infrastructure services need to demonstrate profitability. That means more pressure on margin improvement, potential consolidation of roles. One infrastructure engineer doing work previously split across two. Shift in hiring toward ML engineers and product managers who can drive revenue-positive AI products. Google's employee review cycles in Q4 2024 reflected this. Infrastructure teams had lower promotion rates than product team. That's a signal that the company is shifting capital from infrastructure cost center to AI product revenue driver. Scenario C. You work at an AI startup. If you're at OpenAI, Anthropic, xAI, or another frontier labs company, the dynamic is different. These companies are still raising capital aggressively. OpenAI just closed a $6 billion funding round in October 2024 at a $157 billion valuation. But the capital is more expensive now and there are more strings attached. Investors are asking, 1. When does compute spending justify itself with revenue? 2. What's your path to profitability? 3. Why should we fund your 5-year compute roadmap if NVIDIA growth is decelerating? For workers at Frontier Labs, this means equity grants still have substantial upside. These companies will likely IPO in 2026-2027, but salary and bonus might be more conservative, more focused on shipping products that generate revenue, not just research papers. Scenario D. You work at an AI infrastructure startup, Hugging Face, Databricks, weights and biases, etc. This is the trickiest spot. These companies benefit from the AI ecosystem, but their customers are all companies now cautious about infrastructure spend. Databricks raised $500 million in Q4 2024, but at a 20% lower valuation than their Q4 2023 round. That's a signal. Their employees' equity grants are worth less than they were 12 months ago. Unlike Frontier Labs, which raise capital independently, infrastructure startups need to convince their customers, hyperscalers and enterprises, that they're worth paying for. If those customers are slowing spend, growth slows. If growth slows, funding becomes more difficult. For workers here, means equity might be underwater relative to past grants. Hiring will be more selective. You're competing more directly with free/open source alternatives. Part 4. The 3 scenarios going forward. Let's map out what happens next. Scenario 1. Soft landing, 40% probability. NVIDIA growth moderates to 20-30% growth through 2025. Companies work through inventory. Demand renormalizes at sustainable levels, and NVIDIA stabilizes as a $100+ billion revenue company. Stock stays flat to up 10% annually. Tech compensation adjusts downward 10-15% through bonus and hiring pace, but remains strong. This is basically the mature growth company outcome. Scenario 2. Sharp correction, 35% probability. AI capex spending continues to slow as companies realize ROI challenges. Revenue from AI products isn't matching the spend. NVIDIA guidance drops to 10-15% growth by mid-2025. Stock declines 30-40% from recent highs. Tech layoffs accelerate. Compensation becomes salary-driven rather than equity/bonus-driven. This is the recession scenario. Scenario 3, market reset, 25% probability. AI reaches genuine scaling inflection with major new applications, embodied AI, autonomous systems, scientific discovery that justify capex spending. Demand reaccelerates in H2 2025. NVIDIA guidance recovers to 40-50% growth. Stock recovers and moves higher. Tech compensation rebounds in 2026. This is the doomers were wrong scenario. Conclusion: NVIDIA $40 billion in AI revenue is real and impressive, but the 81% deceleration in guidance is a signal that the easy money is off the table. For tech workers, that means 1. If you're holding NVIDIA stock,